Welcome to Accounting in the Wild, where we'll discuss various subjects in the tax and accounting world, also featuring tales from the field and interviews on various tax and accounting subjects. All this and much, much more on Accounting in the Wild. And now, here's your host, Jason Dynison.
Well, welcome to Accounting in the Wild, and we have our first guest with us. Randy, this is something you can tell the kids and the grandkids and everybody you meet that you are the first guest on Accounting in the Wild. Randy Eickhoff, welcome to the podcast.
Thanks, Jason. I'm excited to be here, and happy to be your first victim. I mean, interviewee.
Right. Well, let's start this podcast with the stereotypical question. Tell us about yourself. Just a little kind of elevator pitch about Randy Eickhoff and your company also, before we get into the research and development credit.
Yeah, well, I'll make it pretty quick. I started my career at Arthur Andersen, and depending on your listeners, Jason, they're going to know who that is or not sure. One of the big 8 accounting firms back in the day, and found that while I enjoyed tax in school, compliance really wasn't where my head was at. So left Andersen after about 8 years. I'm a slow learner, and went into recruiting. Did that for a while. A company called Korn Ferry, one of the largest executive firms in the world. Worked on positions paying $200,000 and above. Went from there to a friend called and said, "There's this thing called research and development credits, and the rules have changed that now apply to small businesses." And I said, "Well, I'm not that interested, but let me help you. I'll make some phone calls." Well, the short answer is I realized after making those calls just how impactful the credit can be for companies. And after 4 years at Korn Ferry, left there, I started doing R&D credit work and layered on cost seg when we got to Acena, and have been doing that now for about 20 plus years. I know I don't look it, but 20 plus years, and haven't turned back. It's just been a great ride and really generating millions of dollars for folks legally, which is the best part, with incentives the government wants people to take advantage of.
So Acena Consulting, we're here today to talk about the research and development credit, but you mentioned cost segregation. There's several things that your company does, correct?
That's right. So those are the 2 things that we focus on. R&D credits is really the leader, and we've been doing that consistently. About 3-4 years ago, we layered on cost segregation, which is a real estate incentive for companies that or for people that invest in real estate. And both of them drive significant cash flow. But we focused on those 2 areas because there's so much value in them, and there's so many companies that still have an opportunity to take advantage of that.
So we'll have Randy back on at least 2 more times, or maybe even more than that if we don't scare him away today, to talk about like audits of research and development claims and also cost segregation, and then some practice management things too. So we've got some different things. But today, Randy, we're focused just kind of on the basics of the R&D credit and also what might be changing here in 2025. So a lot of practitioners, I think, don't really either know about it or understand R&D. And also we have some businesses that listen to this podcast too. And so this might be an initiation for them on what are we talking about with the R&D credit?
What is this crazy credit that's out there? Jason, the elevator pitch that I used to give when somebody would ask me, what is the R&D credit? My response would be, if you're making something and making money, we might be able to help you save some tax dollars. It's gotten even better than that with an election that's made that you can use this to offset payroll taxes. So if you're creating something, and by that I mean a new project, a new product, a new process, a new formula, a new software, a new invention, like a machine, and you're using science to solve the problems around creating that, you're going to pass the test for qualified research and development. And if you're still in a loss position, but you've got employees on staff, you can use the credit to offset that payroll tax. So it's gotten better and better every year.
That's huge because a lot of businesses that would qualify are going to show losses for a number of years at the start. And if so, Form 6765 is the form, correct? So they can, if they have taxable income, I suppose they could use it on their business tax return. Or hey, what are you finding people are doing in the real world? Are they using it on their tax return, or are they doing the payroll route?
Most companies, the payroll route is only allowed if you've had losses 5 years previous to the year you're filing. So it's limited really for startups, and that's where it should be. So most companies are making money. It's also available for flow-through entities like partnerships and LLCs. So perhaps the company has a tax loss because the owner is taking a large salary, but the owner's paying tax at the individual level. Well, those owners can use the credit to offset taxes at the individual level as well. Might be a higher tax rate marginally, depending on how the company is set up.
So you touched on this, but what are some of the industries that you have dealt with? I'm sure it's a large number. It might be kind of a difficult question to answer, but what are some examples of business types and industry types that qualify for this?
Yep. So this will apply to pretty much any business type. So C Corps, S Corps, LLCs, sole proprietorships, single member LLCs, disregarded entities. On the industry side, the easy one is software development. Right? There's the process you go through to develop software is just very simply meets the tests. So that's an easy one. Engineering in all forms typically will qualify, whether that's mechanical or civil. Architecture is another great industry where we find stuff. Product development, technology, obviously. All the renewable energy stuff that's going on, all the products are being created. That's fantastic when you look at R&D plus all the other credits that industry is getting today. We'll see what happens tomorrow, but today. So in our world, it's about 30 industries that touch this credit in some way, shape, or form.
Wow. So you talked about making the credit, Form 6765, on your income tax return or the flow through or whatever, or the payroll option. But how do you, what are some of the mechanics of making R&D claims?
So there's two pieces to what has to come together for you to finish that form, and more importantly, substantiate it in the event of an audit. The first one is developing the expenses. And there's 4 categories we pull in: wages, supplies, contract research, US-based, and cloud services for development, typically applying to software developers that are developing software and using cloud space for development space. The other piece is the projects themselves. They have to meet a set of tests, 4-part test, in order to qualify. And that really revolves around eliminating uncertainties, using science to figure out those answers. And so you have to develop the documentation around your projects and define your projects appropriately. And then you've got to categorize your expenses and make sure that you're defining them correctly and then categorizing them as qualified R&D.
So now there was something that changed a few years ago on the payroll side, right? Where the credit amount was doubled, correct?
Yeah, and it's sort of an interesting way that Congress does that, right? So that applies to that payroll election. Essentially what it says is that you can generate an R&D credit and use it to offset your payroll tax expenses in the year in which you generate the credit. So we generate a credit, we make the election, then on a go-forward basis, we're going to offset those payroll taxes. I think the number right now is at $500,000 is the max. Okay. In order to generate $500,000 of R&D credit, you got to be spending a lot of money. Most startups are not going to be spending anywhere near that amount in order to get there. So it was probably not the right way to say this, but it was a political win that doesn't really going to affect a lot of people because they're not spending enough to get to that $500,000, but it's there for them.
Well, and that brings up a good question, actually. How large is this credit? What are we talking about here? Apparently, it's not 500,000 in very many cases. So, what is a typical credit claim, I guess, or what are some examples of what a business might get back?
Yeah, so at the federal level, you're looking at about 8.5%. So for every dollar you spend, that's qualified. We're going to get 8.5 cents tax credit, dollar for dollar credit to reduce your taxes. At the state level, it's all over the place. Arizona says it's a 24% credit. When you apply all the limitations and everything else, comes out to about 11.5%. California, 15% limitations, gets it down to about 7.5%. Today, Michigan signed a bill. They now have an R&D tax credit, 15% for small businesses, 10% for large companies. There's 37 states now that have a state level credit. So use California, my home state, as an example. You're getting 8.5% at the federal level, another 7%. We're talking 15%, 15 cents on the dollar for every dollar that you qualify for research and development as a tax credit. That's pretty good.
That is pretty good. So what are some, I mean, you just mentioned Michigan, but like, what are some of the changes that are looming? And on that line, you posted something on LinkedIn the other day. It was a poll about something with expensing versus capitalizing, right? Hopefully I'm quoting that correctly. And that seems like it's one of the looming potential things that we need to watch for. Like, what are some things with R&D, I guess, the credit and expenses that we need to be watching for?
So there's a bunch of changes that have happened over the last 12 to 24 months that some are good, some are not so good. One of them you absolutely hit on the head, and that is capitalization. The TCJA, which I'm sure you're very familiar with, that came out in 2018, had a provision that said beginning in 2022, you must capitalize your R&D expenses to the balance sheet and amortize them over 60 months. Now, Jason, as good as the credit is, it does not mitigate the negative impact of capitalizing at a combined 35-40% tax rate for federal and state. And so we've had a lot of clients that have paid more taxes in order to be allowed to innovate. That's the best way for me to say that, over the last couple of years. Now, with that said, last year, there was a bill in Congress, the Child Tax Credit Bill, that had a provision that would have reversed that capitalization back to expensing, which is what it has been since I've been involved with the credit. And it got killed in the Senate. Now, that was for political reasons. So both sides of the House want this to be fixed. So we believe that in the coming tax provision, the Tax Act that we expect in 2025, we're going to see this get reversed. So we'll go back to full expensing, and this is going to be a really good thing for all taxpayers that are out there. The downside to capitalization is that it's really killing small business. Large companies, billion-dollar companies, multi-billion-dollar companies, the amount of R&D that they spend relative to their revenues and their bottom line, the capitalization is really a rounding error. It's not a big thing. But for a company that's $3, $4, $5 million in revenue that spends $1 million in R&D, and now they've got to capitalize $1 million at a 40% tax rate, now they're paying an extra $350-ish thousand in taxes? Seriously? I mean, China provides a 200% deduction for R&D.
Wow.
So Congress is going to fix this. They've really got no choice if they want small businesses to succeed. So that's only one change. 2025, we're going to see a new 6765 form come out. That's going to have 20 more fields of data that have to be tracked. So we're talking to all of our clients right now about documentation and what they need to do today so they have that data 12 months from now. Refund claims. You file a refund claim for a credit, you have to now provide additional information on every single project that you are qualifying, every single project. So if you're a company that does a lot of innovating and a lot of smaller projects, that's a lot of work. So that has been changing over the last couple of years, and they've kind of narrowed down the amount of work that we need to provide. But we've got to provide additional information when we file a refund claim today. And then really the last thing is the approach on audits, which I know we're going to have a full-blown session on. The IRS is going after companies in a different way as a result of a couple of recent court cases that have gone in the government's favor. And so that's going to require more documentation on the part of taxpayers to make sure they can substantiate their credits.
So that brings up two follow-up questions that I had. One was about making the claims. I mean, we've talked about this already. You either do it on the tax return or the payroll Form 941, but how many businesses that you work with know along the way, oh, hey, we qualify for this, versus later it's like, oh, we did qualify for it, and so now we have to go back and get it by filing either an amended tax return or an amended 941?
Well, that's a great question. And let me start by saying you can't file an amended 941 for this. The payroll tax election has to be done on a go-forward basis.
Okay.
So you lose it, you lose it. This really comes down to the CPA. Their trusted business advisor needs to know enough about the credit to be able to recognize the potential. And we get a lot of referrals. Most of our business comes through CPA firms nationally. And we get a lot of calls that say, can you just chat with my client and kick the tires? Let's see whether or not their projects are going to qualify. And we're very transparent with our clients to say, yeah, this one's not going to work for you. And here's why. Let's understand the reasoning. A lot of cases, they might be doing qualified R&D, Jason, but if it's for a customer and they have a funded research situation where there is no risk in the development, then that project's not going to qualify. So they just change the way their contracts work, and all of a sudden they may have qualified R&D. So there's some proactive things that can be done to help companies take advantage of this, but it all comes down to their trusted business advisor being able to recognize the opportunity when they're doing that tax planning and be able to bring us in to help understand it.
And so there would be the standard three-year statute of limitations, I suppose, on going back on this.
Yeah, and we do. If we've got companies that either we had a company last year that had been taking it in the past, stopped for whatever reason, and then changed CPA firms. Their CPA firm brought us in, and we ended up doing a 4-year study for them, blowing up all of their projects to meet all the requirements. And then we ended up getting them about $900,000 worth of credits, federal and state.
Is there any kind of lifetime limit on you can only do this credit so many times or so much of a dollar amount?
No, but there's some limitations relative to, I guess, size. There's a couple different ways to calculate the credit. The traditional way requires that as your revenues increase, you have to increase the amount of R&D that you're spending. And so that provides sort of an inherent limitation potentially. If you always grow, then you're always going to have an opportunity. The other way, it requires the evaluation of the prior 3 years. So if you've got 3 big years of R&D and then where maybe you back off a year, you might not have as much R&D or not qualify at all. But then that year goes into that 3-year average and you might have some the following year. So there's some limitations that are built in, but the short answer is, Jason, most of the time you're going to be able to get something.
Now on R&D, I'm sure you're familiar with the Employee Retention Credit, ERC, and the fact that that was kind of the Wild West when it existed, and lots of credit mills, that's what we kind of call them in the field, is credit mills, popped up making very aggressive, well, let's just say wrong claims. Deliberately misinterpreting things so that businesses could get an ERC claim and the credit mill could get, their 25% take on the credit. Does that exist? Are there bad actors in the R&D field like there were in ERC? It seems to me like maybe there's not. Maybe it's just something that not as many people have heard about. I guess I'm answering that question for you. So let me ask it again. Are there very many bad actors in this field?
When when this opportunity came out in 2004 and the rules changed under Bush, I think there was a period where absolutely there were firms that came out that, if you can fog a mirror and you've got a policy, you're doing qualified R&D. And I think a lot of those firms have gone by the wayside because CPAs have gotten smarter about how the credit works. Companies have gotten more educated on the credit and start to recognize that if you're not asking the right questions, there might be something that's not right here. If it doesn't feel right, maybe we need to reevaluate this. And that's the way it should be. So today, are there still some out there? I think there probably are. We've looked at some reports that are a little frightening, and some credit. I saw one credit a while back that the supply costs were 40% of cost of goods sold. And that gave me pause, to be honest. That's a big number. Most of the time, the biggest expense item is going to be the wages of the people doing the work. And so to see that large a number was a red flag for me. I had a client ask me about their return, and I said, well, if I take this over for you, you're not going to have a credit next year because you've been taking so much that the averages aren't going to work out. But I think you're at risk. Let's go look at the details. So to answer your question, yeah, I think there are a few out there. And CPAs as well as business owners should be asking hard questions about the process, the way that they define things. The evaluation of a project is somewhat subjective, and you've got to really dig to make sure the company's doing the right kind of work and activities. And so it's worth asking for references. It's worth asking those hard questions to make sure that you're comfortable with them.
Yeah. And you have over 20 years of experience with this.
I do. It's hard. I don't know how I got here. I really don't.
Here we are in 2025. It's crazy. So your last answer kind of drives what would be the final question, I guess. And that is, what are some potholes? What are some things that tax pros, CPAs and EAs and whoever might want to refer a client to you? What are some things that they should be asking? I don't know, I guess where I'm going with this is, why hire someone like you to help with this?
Yeah, so that's a two-sided question, right? What do they see in the client's business that year that would suggest a credit? And then why hire a specialist? If revenues are going up, the big question is, what changed? Why did your revenues go from 2 million to 2.5 or 20 to 25 million? Oh, we developed some new products. Right? That's an easy one. If there's an acquisition, well, what did you buy? Did you buy innovation? Did you buy some patents? Did the company doing innovative things? That should be a flag to say we should look at the R&D credit for this. Why hire a specialist? Well, there's a reason most CPAs don't do this. One, the work is very time intensive. The rules are complicated. Literally, a project can qualify or be disqualified as if one sentence in a contract can make or break whether or not it's going to fall into the qualified or non-qualified bucket. And so having someone that lives and sleeps with the definitions of research and development as the IRS sees it, we know these answers for the most part in our sleep and can answer those questions easily for clients versus, well, no, I'm not making this up, Jason. We got a list of projects from a client, and one of them was implemented a new 1-800 phone number. Okay, that one came off the list. So business owners too, they'll want to be a little bit more liberal with those definitions, and those will get blown out, if they go under audit. So we want to make sure that, it is worth spending the money to make sure that you've got good representation and that the provider is going to back that up on audit. And all of our claims come with audit defense.
And last question, this really is the last question. I know you're going to come back and talk to us about the IRS and what they look for, but are they is there an auditor reviewing these claims when they come in and saying yes or no to them on the spot, or are these kind of like other things where it's it gets processed and then maybe it gets audited, maybe it doesn't?
Yeah, so I think the IRS has a number of different levels of review. A claim filed on an originally filed return goes through an electronic process. So I'm not sure that there's a whole lot of, other than some very superficial, does the credit make sense for the industry and the size of the company kind of analysis that's done automatically by the computer systems. For the returns, the refund claims, somebody does have to hold those and look at them. And so the extra detail that's provided is going to be reviewed for somebody to see whether or not it's going to qualify. This whole new process that they have in place is because they were getting amended returns, people asking for a six-figure refund, and all they've got are a few numbers on two pieces of paper. So now they've got detail on the projects. They're understanding what the technical uncertainties are relative to those projects and whether or not they feel that given the industry, whether that makes sense for that kind of a company. And in that case, there is someone over there looking at it. If it ends up getting pulled for review, it's a much bigger fight and a much tougher uphill battle. The agents in the field don't have a ton of experience with the credit. And so the audits that we've been involved in, we find them, making assertions that just don't hold up, when you look at the regs and the code. There is a group within the IRS that focuses specifically on research and development credits, and those folks are pretty knowledgeable and really have their act together, but they're only called in what I have seen, primarily at the appeals level. Perhaps on the larger multi-billion-dollar clients, they're going to see some of that on an initial audit, but it's really where appeals where you get an SME from the IRS that comes on, and they're much more reasonable in terms of having a discussion about the projects and documentation.
All right, well, we'll have you back to discuss more about the IRS and what they look for in an audit. But just to wrap things up here, Randy, if you have a tax pro listening to this, they want more info about what you can do, what's the best thing they can do to find more information?
Yeah, so you can go to our website, Acena Consulting, ACENA Consulting.com. We might have a form on there or two to contact us directly and phone numbers and stuff. And happy to have conversations to kick things around, no client name basis, to understand how we can best support them. Jason, the best thing about working with CPAs, and you know this from the industry today, finding great people to do the work is getting harder and harder in our profession. There's just not enough kids coming out of school. And so we're able to provide a service line to that CPA firm that they don't have to add headcount for and serve their clients in a better way. So that's why we're here.
Absolutely. Well, Randy Eickhoff, thanks so much for being the first guest on Accounting in the Wild. Hopefully we didn't scare you away.
Not yet.
Not yet. Right. Maybe next time. We'll have Randy. We actually have three other things to talk about, don't we? We have audits of R&D, we have cost segregation, and then some things on practice management and running your firm. So
yeah, we've done some really cool things in the last couple of years at Acena that I can't wait to share with the listeners. That have really taken us to just a different level in terms of culture and accountability and buy-in from our team.
Excellent. Well, Randy will be back with us again soon. So thanks for joining us on this episode of Accounting in the Wild. We'll see you next time.
Thanks for listening, and join us next time for another edition of Accounting in the Wild with Jason Dynison.